Welcome to holisticinvestment.in YouTube channel. We help individual investors like you to take a right financial and investment decision. Avoiding stupidity is easier than seeking brilliance. One simple way to become a smart stock market investor is to learn from the mistakes of other investors and avoiding those mistakes. Amit Gruver, a financial market expert, is with us today to list down the biggest investment mistakes investors commit, and he is also going to take us through the tips and techniques to avoid those mistakes. Amit, over to you.
Generally, when we talk about equity, it's been projected as wealth creator. Yes, it is a wealth creator from a long-term perspective. I'm sure you must have seen this slide many times, but it's important to have a rehearsal or a repetition of it because we wanted to understand it, go and be part of your memory. Equity market in the last 42 years, the Sensex has moved from 100 to 58,000. Amazing amount of wealth. But unfortunately, people think this journey is a straight line. Journey was never a straight line. The journey was always full of ups and downs. There were good times, bad times, horrible time, crazy times, amazing times. This is all part of the journey of equity market. Obviously not in this order. The orders can change, but this is the nature of equity market. Let me try to tell you the mistakes what generally people do when it comes to equity investment. A very interesting thought by a person called as Charlie Munger. Charlie Munger is one of the smartest brains in investments across the world. And he says something very interesting. He tells, tell me a place where I will die and I will never go over there. I will talk about certain mistakes, what people do, certain mistakes in terms of where people die in terms of investments in general. Okay, I'm sorry, I've used a very harsh word called as die, but the better word is financial ruin. Okay, when it comes to investments and money management in general. This is how typically markets look like. This is a good part about equity market, or this is an amazing part about equity market when equity market is doing exceedingly well. Like this is just an example. Okay, it's not a view. It is not trying to extrapolate anything. From 2003 to 2008, equity market did phenomenally well. Okay, during these times, equity market moves like Ferrari. You might start believing, oh wow, equity is moving so fast. Why should I put money into fixed income, which is very safe? Or why should I put a little bit of money into gold also? Because they are moving very fast. Why sit in a bullock cart when equity market can give good returns? A lot of people make fundamental mistakes that during good times, they overinvest their money into equity market. Let me tell you the second part of equity market. 2008 to 2014, for 6 years, equity market gave you no returns, practically zero returns. So now this Ferrari has become a bullock cart. It's like a traffic jam in a bullock cart. Bullock cart still moves. It is just moving without, you are stuck for almost 6 years and it's not giving you no returns. And you will say it's horrible. Equity is a pathetic asset class. Equity gives no returns. I dislike equity. The better option is fixed income. During this time, we lose faith in equity market. Now, I'm not saying I'm not for equity or against equity. What I am for, I will try to explain you. I'm for with a very interesting principle, which is called as asset allocation. And what do you mean by asset allocation? It's like a balanced diet. I'm not for protein or for calcium or for vitamins. For me, a good healthy diet have carbohydrates, has vitamins, have proteins, have water and have salts all in right proportion. So the idea is, yes, from 2003 to 2008, equity market was doing well, fixed income or gold was not doing well. It's fine. Have all three in your portfolio. Gold, maybe like 5 to 10% of your portfolio can be into gold. Physical gold, digital gold. Obviously, your advisor will be in a better position to explain you, or a combination of it. Fixed income is very important. It behaves like a cushion, okay, during tough times. Just as an example, from 2008 to 2014, when equity was not doing well, gold did very well, fixed income did very well. During these times, the interest rates were around 10, 11%. Fine, equity is not giving you returns, fixed income is giving you good returns, gold is giving you good returns, equity is not giving you a return. Overall, your portfolio has done very well. In the similar fashion, equity is doing well, fixed income and gold are not doing well. Overall, your portfolio is doing well. For me, actually, asset allocation is like building a team for IPL. It's very difficult to say on a particular day which player would do well. But once you have a portfolio, a combination of various different personalities, sometimes X player does well, sometimes Y player does well. The same thing happens in financial planning, which is called as asset allocation. So I'm always perpetually bullish on asset allocation. If you ask me which asset class will do well in 2020, whether fixed income will do well or equity will do well or little bit of gold will do well, I will say, I don't know. I have got all three in my portfolio. Either of them will do well. When you look at the smoking, when anybody smokes and you look at what is written out over there, it's written, smoking is injurious to health. For me, in the similar fashion, prediction is injurious to your wealth. The idea is have a combination of fixed income, have a combination of equity and a little bit of gold into your portfolio. Either of them will do well. One will be first, second will be second, there will be a third, and the winners will keep on changing. Overall, your portfolio will always be winning. That's the idea of asset allocation. Now, I've again used the picture of Einstein, and I'll try to explain you a very interesting story about Einstein when he was asked about the eighth wonder of the world. We all know about the seven wonders of the world. Einstein said the eighth wonder of the world is called as compounding. And compounding formula is taught in class fifth maths. Okay, what is compounding? Let's say what this formula of compounding says. To explain this, I will use a very simple example. And I will request all my participants to put the answer in the chat box. I have put a picture of a lotus, okay, on the top. Let's say there is a pond and there is a magical lotus over there. And this lotus doubles, okay, in number every day. So it starts with number 1. On the second day, it becomes 2. On the third day, it becomes 4. On the fourth day, it becomes 8, then 16, and so on and so forth. On the 29th day, the pond is half full. So it takes 29 days for the pond to be half full. How many days will it take for the pond to be completely full? A question to all of you. I hope you have got the question. So basically, there's a magical pond. First day, 1 flower.
One more day. It will take 1 more day.
Absolutely. Honestly, it sounded like a very difficult question, but it's a very simple answer. It will just take 1 day. So when you hear this for the first time, the first thought which goes to the mind that it took 29 days for the pond to get half full, but it took just 1 day for the pond to get completely full. That means 1 day was equal to 29 days. And this is such a magical principle. It's called compounding. People say, you know what, how do you create wealth? And the answer is very simple. Start as early as possible. And I'll give you a very simple example. Let's say there is somebody who starts at the age of 30 of 5,000 rupees, okay? And a simple SIP, we all know SIP, it requires no deduction. At the age of 60 in 30 years, at 12% return, the corpus becomes 1.76 crores. Now, to build the same corpus of 1.76 crore, if you start at the age of 45, you have to actually invest 7 times more money. You have to start an SIP of 35,000 rupees. And this explains something in a very interesting way. The hero or the biggest actor in the entire story was actually time. In fact, the biggest wealth creator in the world, Warren Buffett, who just celebrated his 91st birthday, he started at the age of 11. And generally, when people ask him, sir, what is your biggest regret? He says, I started very late. I wish I would have started earlier. That means even after starting at the age of 11, he has regrets that I wish I would have started early. This is the magic formula. I hope all of you understand. And I'm wishing and hoping that we have got some young participants over here. The hero in the entire story is basically time. And now people who are in their 40s, also please don't feel disappointed that, oh, wish I knew this formula earlier. It's fine. Because what happens, yes, at the 30s, the power is time, but obviously we also have got a lot of expenses at that time. We have got young children at that time. We have got a lot of things, a lot of responsibilities. And most of our earnings actually start at the age of 40. It's fine. Even at 40, if you start and you give 20, 30, 35 years to your money, you will become super wealthy. The hero or the biggest actor in the story of wealth creation is time. Now, if you have understood this principle, okay, and it's not a magic formula, it's a basic idea. Now you might have a lot of questions. Amit, you explained me the benefits of equity. I'm very happy. Equity is an amazing asset class. I also know fixed income is very, very important. I also have a little bit of gold. Now tell me, what is the right asset allocation? And for this, I will not give you a mathematical formula, but I'll give you a very commonsensical formula. common sense is more important. If I ask you, how did you selected your spouse? Okay, you will not say, I am an engineer, I use some mathematical model, I use an Excel sheet. You'll say, no, I used common sense. I had certain parameters in my thought, okay, a certain small checklist, and based on the checklist, I took a decision. Most of the best decisions what we take in life is basically using common sense. Okay, I will give you the right common sense logic for the right asset allocation. Now, have sufficient equity in your portfolio in which you are not worried about your long-term goals. Okay, because you know that as we progress, inflation is going to be there. We have got financial goals. Have sufficient equity that you're not worried about your zero income life for 20, 30 years. You've got sufficient money. You're not worried about your children's higher education or marriage because you have got sufficient money in equity mutual funds to create wealth. But also have sufficient fixed income into your portfolio because markets are volatile. Equity markets will fall by 10%, 15%, 20%, 30%. That's the nature of equity market. You can't do anything about it. So during those times, have sufficient fixed income in your portfolio because you also need a good sleep. You don't want, you know what, my portfolio is for long term, but when you see your portfolio falling by 10, 15, 20, 30%, it's very human to lose sleep. So have sufficient cushion in your portfolio, which is called as fixed income. So even when market falls, you are able to manage the fall because you've got sufficient cushion in your portfolio. So my thumb rule or my simple logic, build a portfolio in such a way of equity, debt or fixed income, or little bit of gold into your portfolio, and also having emergency fund for uncertainty and having a health insurance and life insurance. Have it in such a way that you are able to sleep very well, sleep like a baby, that you're not worried about your financial goals. I see a lot of investors who have put a lot of money in equity market. Okay, unfortunately, they always get worried. Oh God, markets are falling. Russia, Ukraine, markets are falling. What do I do? I also know a lot of investors who have got all the money in fixed income, a majority of money in fixed income. They're always worried. Oh God, expenses are so high. How will I manage it? Have a right combination. Neither you're worried about the future, neither you are anxious in the present. That's the right asset allocation, according to me. Now, the science work, you have to sit with your advisor, you have to sit with your planner and understand your goals, share your risk appetite, and be very honest with your temperament. And your advisor will know you well, your financial goals, in terms of your temperament, how much your earnings, your inheritance, and a lot of things. And then they will decide the right asset allocation for you. I will just talk about two big money mistakes which people do. Honestly, it has got nothing to do with money. What has happened? We live in a world of 24/7 noise. Okay, media, internet, television, radio, magazines, newspaper, honestly makes us anxious on a daily basis. A very interesting quote by a very smart techie and a very amazing philosopher called Naval Ravikant. He says, media's job is to present every problem as your problem. Just as an example, Russia-Ukraine is a war which is happening, okay, a problem which is happening in one part of the world, but it's projected to us as if it's our war. Or for example, what's happening with Pakistan recently? I'm sure you must be hearing about the turmoil which is taking place over there. Okay, it's been presented as if it's our problem. Similarly, what's happening in Sri Lanka? Similarly, what's happening in our country also? Various states, various elections, we start believing that every problem is our problem. Unfortunately, budgets come, it has been shown as if it's our budget. Our job is to manage our financial budget. It's the country's job to manage their own budget. But we get so much involved in all of that as if every problem is our problem. Our job is very simple. Our job is to ignore the noise, build a process, stick to a framework, work with our geometry, and stay invested. Second thing is we also get carried away by what others are doing. I know a lot of investors buying cryptocurrency, and I ask them, why are you buying it? They say, because everybody is buying it. I see a lot of investors buying direct stocks, and I tell them, why are you buying it? He says, they say everybody is doing it. If I ask anyone why they're doing most of the stuff in life, and the answer is because everybody is doing it. Don't just do it because others are doing it. Stick to your financial goals, stick to your plan, stick to your risk appetite, stick to your understanding about markets, and stick to what your advisor or financial planner tells you. Don't get carried away by what others tell you. Lastly, there is no story in the world which is more fascinating than the story of making money very fast. Every day when I read newspapers, in the morning I was reading newspapers, the idea is I read many articles where somebody got fooled. Okay, smart people, okay, smart cricketers, smart politicians, smart intelligent celebrities, smart doctors. Unfortunately, somebody told them invest over there, you will get 12% return guaranteed. Or you put your money will get doubled. Or invest into this real estate project and do a lending, guaranteed you will make 22% return. And people fall into these traps. The idea is there is no story which is more fascinating than the story of making quick returns. The idea is very simple. Charlie Munger says it very beautifully. And again, I'm repeating it. Tell me a place where I will die and I will not go over there. Anyone who tells me any scheme of doubling your money or idea of making quick returns, I just get away from that. Please don't even listen to their conversations. Lastly, couple of points. Investment is not entertainment. Unfortunately, it's been shown as entertainment in news, in TV, and when we discuss with our friends, you know what, I invested into this stock, I invested into this markets in equity mutual fund. It gave very good return last 2 years. It's not entertainment. When you invest, think about your family, think about your goals, think about your peace of mind. Yes, there will be periods when equity will go up. There are periods when gold will go up. There are periods when fixed income will do well. We are in the profession of personal finance. We are not in the business of entertainment. If you want entertainment, don't get into investments. Do go to a casino and have entertainment, but don't treat investments like casino or entertainment. Lastly, I'm sure we all have Nike shoes, and possibly we also go for a run to maintain our good health, or maybe go for a good walk. Nike's slogan is just do it. But if I have to give a slogan to investment, I will just say just do nothing. And why do I'm saying just do nothing is the best slogan for wealth creation? Because what happens is that wealth gets created. Okay, we have been programmed by the world that to become rich, you have to be very super aggressive, smart, intelligent. Honestly, you don't have to do any of these things. You have to be very patient. You have to be very lazy. You have to ignore the noise. You have to be less aware about the world. The idea is you don't have to sit with a telescope. Oh, sorry, with a microscope. Because when you sit with a microscope, the world shows you all the problems in a very big way. Like today, when you switch on the TV, it talks about the end of the world. People talk about World War III, okay, end of the world, because you're sitting with a microscope. Every problem looks very big. You have to sit with telescope. And what is a telescope? Telescope helps you look at different galaxies, different stars, which are very close. What are different galaxies and different stars which I'm talking about? The beauty is, in this planet, we are more than 7 billion people, 700 crore population. India itself has a population of 130 crore plus. The idea is businesses create wealth because businesses sell goods and services. Consumers require goods and services. Businesses create wealth over a longer period of time. Economies work that way. Economies goes through periods of ups and downs. Equity market goes through periods of ups and downs. All we have to do is stick to a process of having sufficient equity, sufficient fixed income, little bit of gold, little bit of uncertainty, emergency fund, health insurance, life insurance. Continue with their SIPs and never stop an SIP. Stay away from the noise and understand the geometry of wealth. Invest in yourself, invest in your health, invest in your skills. Save more money, stay away from friends who have a very high lifestyle. Make friendship with only those people who have a moderate lifestyle. Third, invest wisely, which I've tried to explain using the principle of asset allocation. Fourth, please also learn how to spend money in a very logical way. Spend on things which you enjoy and don't spend on things which don't give you enjoyment. And last but not the least, to feel wealthy, also be socially active, give money, distribute some amount of money to people out there, okay, who are needy. It will make you feel wealthy in general. With this, I will end the session and a very simple call of action. Have growth assets, have equity mutual funds. Also put some money into international funds out over there. Okay, like today you can put money into US, Europe. Okay, and your financial planner will be able to help you which countries maybe you can invest into. Have your core portfolio in India, but some amount of money into international also makes sense.
If you have any questions related to this or any other investment options or related to your financial goals, feel free to book a free appointment with our financial planner. The link to the free booking is given in the description below this video. Also, will you be interested to attend insightful investment webinars? Then feel free to register for our upcoming insightful enlightening investment webinar, and it is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give a thumbs up. Also share it in your social circle. If you are not subscribed to our YouTube channel so far, please subscribe now. Bye.